Today, the main challenge of any investment professional is to sift through data and cut through complexity to make clear, objective, and forward-looking decisions. Now, imagine a technology that can access a deeper dimension of data and help you see through today's market dynamics. MDOTM is introducing Sphere. We created a platform that allows you to combine your experience with state-of-the-art artificial intelligence. Our AI is trained to learn as a human would do. It uses millions of examples to infer non-linear cause and effect relationships in market behaviors. Every day, Sphere analyzes all listed securities, gathering information from macro, fundamental, and market dynamics, such as how a sudden hike in interest rates could alter risk premia, or how sector correlations could evolve in different scenarios. We blend all this with the daily analysis of market regimes and their forecasted evolutions to help you shape your risk and return expectations. Sphere brings customization to scale by helping you design portfolios in every aspect and integrate complex constraints, investment objectives, and views. Experience assisted rebalancing. Define how much to change your portfolio and where it should be headed. Our technology will do the heavy lifting and create adaptive portfolios that reflect potential changes in market conditions. Start integrating AI in your investment process with the most advanced no-code solution. Start integrating Sphere. Enter the future of investments.
Hello, everyone, and welcome to our event, AI for Multi-Asset Portfolio Managers. I am Andrea Sala, your moderator today. During this live event, we will explore the topic of AI for multi-asset portfolio managers and how it can help them easily construct and optimize portfolios at scale. AI is an increasingly prominent topic in the financial world. And the integration of it is not only a current trend, but it is also a rapidly advancing technology that shows no signs of stopping anytime soon. So our primary focus today is to delve into the current landscape of AI for investments and how it can help multi-asset portfolio managers power their investment decisions. We aim to share some key aspects that show how multi-asset portfolio managers have successfully incorporated into their operations in order to construct and enhance their portfolios, as well as combine their views with an AI-driven market outlook. Now, for the past 7 years, MDOTM has been at the forefront of AI development for investments. Drawing from our experience, we have identified a clear and definitive path for a successful AI implementation in the investment process. As part of our dedication to leading this transition, we usually engage in discussions like this one we're having today, to illustrate the process, the best practices, and opportunities of AI investments. Now, as I previously mentioned, for the past 7 years, MDOTM has been at the forefront of AI development for investments. Our team, consisting of nearly 110 passionate professionals and finance professionals, this including the MDOTM Lab, which is our international network of academic thought leaders and industry professionals. Now, our team is spread out through our offices in London, Milan, and New York. Today, we have 2 solutions, these including our portfolio advisory, which is bespoke AI-driven portfolios at a security level for a total of $1 billion in assets under advisory. And then we have Sphere, our AI platform for investment decision making, supporting a total of $70 billion in assets under technology. Now, before we kickstart this conversation, I would like to share with you some market insights that highlight why we're here today. First off, we have McKinsey showing us the most common AI use cases and highlighting how the top ones are the creation of new AI-based products and the AI-based enhancement of existing products, which is exactly what leading financial institutions are doing today, integrating AI into their existing processes in order to enhance them. And we're going to touch this throughout the conversation today. Additionally, we have the CFA Institute highlighting how 84% of investment professionals want to integrate AI in their investment process. And this number seems to be only on the rise. And lastly, but certainly not least, we have Gartner showing how in 2023, AI is a mature technology. Today, investment managers across the world use it to harvest alpha and make more informed investment decisions. And exactly due to these market insights, they highlight why we created Sphere, which, as I previously mentioned, is our platform for investment decision making, but is specifically used to create, optimize, and future-proof your portfolios. Specifically done to bring world-class AI into your processes without any disruption or any coding needed. Now, what does exactly Sphere do? Well, first of all, it combines your investment views with AI's outlook, so you can customize your own scenario. And then it explores all risk-adjusted metrics to see how your portfolio would perform under different scenarios. And finally, you can shape your portfolio in any aspect, since AI will do the heavy lifting and provide all the requirements that you need. This technology is leveraged by numerous institutional investors across the EU, the US, and the UK, including banks, insurance companies, asset and wealth managers, as well as family offices. Before we kickstart the conversation, I would like to highlight the agenda and the topics that we're going to be talking about today. So first of all, we're going to highlight as to why AI today and the prevalence it has, as well as to the specific applications in investments. Then we're going to touch upon how AI can help with alpha generation and the technology behind Sphere, our AI platform. Now, tune in because we are going to have a live demonstration of the platform. We're going to show you how portfolio managers can easily construct and enhance their portfolios with Sphere. And finally, we're going to show you a proven AI adoption guide. And stick to the end because we're having a live Q&A session. So if you have any questions throughout the conversation, remember to leave them in the comments and we will address them by the end. Now, today we have a great lineup of speakers. First of all, we have Axel Meyer, who is our partner at MDOTM, and will be providing his perspective and his rich experience regarding AI and investing. Secondly, we have Lorenzo Malanga, our Vice President of Research, who will help us in having more an in-depth conversation on the technology that we'll be talking about today. And finally, but certainly not least, we have Joanna Fernandez, who is our Client Solutions Manager. She works closely with our clients and will guide us through how our clients use Sphere on a day-to-day basis in order to add value to their investment process. Hello, everyone, and thank you for being here today.
Hi, Andre. Thank you.
Great. Now, in order to kick off this conversation, I believe our viewers would like to know more on a general perspective as to how AI has gained so much traction in the financial landscape. So I would like to kick off the conversation firstly with Axel. With your experience, maybe you can tell us why AI has gained so much traction in the financial landscape and how is it exactly adding value for institutional investors nowadays?
Yeah, very good. I mean, interestingly, artificial intelligence has been around for a very long time, actually since the 1950s. By that time, there was neither enough computing power nor were the costs low enough to make it economically viable. And so this has changed dramatically. This is why now AI is becoming almost like a mainstream topic. One of the biggest challenges we have in the financial markets is the increasing complexity. So it means more and more information is available. And if you look at all these big numbers on the screen here, the one in the middle on the bottom is one that's very telling. So 90% of the data that exists today has been generated within the last 2 years. And this is not going to change. So artificial intelligence is actually one way. It's a very effective and powerful way to deal with that situation. The reason for that is since it does actually work extremely well in rising complexity. It also has the ability to deal with non-linear relationships. And these are the ones that actually help explaining the behavior of markets. And then lastly, it adapts to changes. And this is very key. So in traditional models, if things change, you had to go in and fix it. And so with a good AI, it actually adapts to this very quickly. And although the AI does not predict the future, it is actually helping to make extremely quick changes and adaptation to that. On top of that, we are living in an era of AI democratization. That means that it's not longer the case that the people who actually build AI are the only users. It's very different. So if you think back to the Wright brothers, they were, the ones who built the plane and fly the plane. If we go on a plane today, we just use that technology. And so this is the same with AI. Everyone is empowered and can leverage the AI today in a very, very effective way. So just let me 2 examples. And what we want to highlight here is that AI is just a tool, and the AI in itself doesn't make, it's not very helpful if it's not interacting with humans. And so ChatGPT is something everybody might have known by now. So if you ask it to write a non-disclosure agreement, it does that actually within minutes. And we have done that exercise and showed it to lawyers and say it's a completely viable document. But then if you go on and say, well, make the term of it 3 years, so it goes through it again and makes all the changes, and you go to various iterations, you can say make it according to the German legal system or the English legal system. So it's that interaction between the AI and the human who then come up with very good results in a reasonably short period of time. Another one, another generative AI is Photoshop, which also comes up with a very good dialogue ability. So here we have, we see a salt lake, and you can just say, well, I want to have a car in it. You can also say what kind of car. And you see it puts the car and it fits ideally. There's the right shadow and all of that. And you say, well, can you just add a little puddle to it as well, so to make it more dramatic? And it does it. And again, all the mirror image of the car is there. So it's really up to the person who uses Photoshop to come up with very interesting pictures at the end of it. So it's that interaction that's really, really helpful. And you can see that, here are just a couple of logos of companies that use AI very effectively. And if you look through them, you can see it's across many different industries. And so you can see the AI is really around us. It's nothing completely new. It's just something people can engage with and can use that power that's given to them. So how does it apply to the world of investments? And this, if you think about what I said earlier about the adaptability, this is one of the key things. So if you go through an investment process, there are many different parts of it, whether it's the idea generation, whether it's an asset allocation, portfolio construction, you will go through scenarios, and you can do all of that within the AI. So you can basically pick the areas that are helpful to you and then use that part for yourself. So let's take a step back. Think, an investment process in a very, high level form has basically 2 parts. It's the idea generation, where do you get information from? What do you do with them? And how do you come up with, the right securities in your portfolio? And then how do you put them together in a way that also enhances the returns that you have? So with AI, we can do this in a neat way. So we basically, initially, we basically start from, we can have forecasting alpha. So this is your forecasting of returns, risk, etc. That, of course, adds value, but then also the way you put these securities together is adding value. So if you add to this now the AI component, then we can show through the work we have done for our clients over the last 7 years that AI can add significant alpha through the right forecasting of returns, of risk, and of market regimes. So we are adding to that, and it's a modular part. Then you go to the next one where you put everything together, where we construct a portfolio. So then here, we also have an alpha that's actually generated through the construction. And without going too much into details, if you look at the top chart, the 2 groups of portfolios is basically absolutely equal portfolios, same forecast, same scenarios, are ones optimized or put together by Sphere or using a traditional mean variance Black-Litterman model. And there's another level where you can add alpha. And as I say, it's modular. You don't have to do everything. You can just use and pick what's actually helpful to you. Right.
Okay, thank you, Axel. That was a very helpful explanation to explain to our viewers as to how AI has gained so much traction in the financial landscape and how it can really add value, especially through alpha generation. Now, I'd like to take more of a deep dive into our actual platform, Sphere, and all the features and the functionalities it has and how each functionality can add value. Now, next up, I would like to ask Lorenzo, our VP of Research, since you work so closely with our technology and you know it so well. Could you maybe highlight for us the main functionalities that Sphere have, what they do, and, well, how are institutional investors leveraging these functionalities in order to add value into their investment process?
Well, thanks for the question. Actually, I'm really proud to show our little baby, let's call it the way. Actually, of course, what we started with was building a powerful engine, but then we built this platform in such a way it basically met our clients' expectation, and in terms of making our engine actually actionable and easily usable. So in our dashboard, basically we have some sections that on one side pertain on how our AI sees financial markets, and it is divided into Outlook, Outlook Focus, and regime analysis tool, and a portfolio studio section. Starting from the first block, basically, we have a dashboard with all the quick links and really high-level information you would like to expect when entering the platform for the first time. And then, basically, the structure mimics how the hierarchy of information is basically structured within financial markets. So you have this Outlook Focus, which basically gets to a, let's say, asset class level. You are able to compare positioning indicators, drivers within and against different asset classes. Then, of course, you can dig a little bit deeper in the section that we call Outlook Focus, where you basically can go an extra layer of detail. You will find predictive analytics that we build, some relevant market measures that are relevant in order to assess how a micro asset class has behaved or is expected to behave in the future, and so on and so forth. Concluding, let's say analytical section that pertains about the market, there is the regime analysis tool, which basically is a section on how we assess risk regimes on specific geographies and specific asset classes, which give again an extra level of detail on this section. And last but not the least, there is the portfolio studio section, where you basically all the information converges, and where there is also the interactive part, the human in the loop part, which is again being able to adjust market views, plug constraints, set references to the portfolios. There will be time to go through this section, but basically it's all where you can basically play and interact within our AI.
Thank you, Lorenzo. Now, our viewers are surely wondering, with all of these functionalities, how is the technology all behind all of this working? Like, how does it work? What is the methodology that is used behind Sphere?
Cool. Let's speak a little bit more about the engine then. So basically, Sphere methodology relies on two big building blocks, two pillars. The first one being the non-chronological learning module, and the second one being the regime analysis module. So basically the first, and they work in resonance, of course. So the first one basically tries to capture the slow moving part of the market. So how risk premium evolve over time, how basically fundamental data shapes future return, and so on and so forth. And the name that we chose, like the non-chronological learning, is to stress the fact that since financial time series are really noisy, there is a high level of regularization in order to be able to generalize future patterns, to learn non-linear dynamics. Because here the risk is to basically just memorize data, memorize past patterns, which are not gonna replicate in the future. So this phenomenon is called overfitting, and one of the main goals of this section is to avoid that risk at any cost. On the other side, we have the module that pertains on the fast-moving part of the market. So the fact that maybe on markets, some periods could behave in a similar way, and then suddenly the risk outlook can change. So this section basically tries to understand how coherent are risk measurement across different asset classes, within geographies, and it produces a probabilistic forecast of what the outlook regime is going to be in the near future, or even at larger time horizon. So by combining the two, we have basically, again, the non-chronological learning part that really understand fundamental data, price dynamics. So basically the slow-moving part, so like actually the fundamental part of the market. Whereas the regime analysis tool quickly adapts to sudden market changes and shifts in how risk premia actually pay off over time. So by combining the two, we get a holistic modeling, which basically limits the fact that in financial markets you really have a low signal-to-noise ratio. So this is basically the powerful methodology that fuels every section of Sphere.
Thank you, Lorenzo. Now that we have covered the basics all the way as to how AI can add value to the investment process, all of the functionalities that are in Sphere, as well as how the technology works behind it, I believe we should jump into more of the practicality of it and actually see a live demonstration of Sphere. So I'm going to call on Joanna, who's a client solutions specialist and uses Sphere on a day-to-day basis with our clients and knows how well they actually use the platform to build and optimize their portfolios. So Joanna, I'd like to ask, could you show our viewers how you can construct a portfolio on Sphere and easily enhance it?
Sure. Hi, Anna. Thank you. Hi, everyone. Thank you for being here. So in order to start showing, I will just share my screen so that we can go directly into Sphere. As Lorenzo was saying before, Sphere is divided in 5 sections. He briefly covered a bit all of them. I will jump straight to the last one, which is the Portfolio Studio. As Lorenzo was saying, this is the most interactive part of Sphere, is where everything that is on the other modules come together, and is also where the users can actually interact with the technology. Just to give a bit of a context on the structure we are currently seeing, on the Portfolio Studio, Sphere was developed to fit several and different investment processes. So we always give the opportunity to tailor every aspect of the process or every limit objective that needs to be set by portfolio managers. And they can either use Sphere's estimates, Sphere's views, and Sphere's universes, or if it's necessary to comply with the specific aspects, they can adapt all these to their own views and their own universes and references. And this is why we have these different sections. So we can save our own market views, which can be different from the ones that Sphere generates. Portfolio managers can upload and edit their specific investable universes at any time, so that they can work with their own basket of assets, their own selections. Then we have the possibility to upload reference portfolios or create custom benchmarks that should guide the allocation and that should be used for all the analytics part. And finally, we have the portfolios, where, as Andre was saying, we can either create portfolios from scratch with Sphere, or we can upload and monitor and manage with Sphere portfolios that already existed and that are already being managed by the portfolio manager. These portfolios, they cover a wide range of instruments. They can be constructed in indices, in ETFs, in funds, in single instruments, and they can be any type of portfolio. So, for example, in this page, you can see portfolios that cover sectors, that cover specific geographies, or multi-asset portfolios, global multi-asset portfolios in this case, which are the ones we are going to take a better look at. As you can see, as soon as I enter this portfolio, I already have an alert from Sphere. We will address it in a bit. Just to give you a heads up, Sphere has an entire system that allows portfolio managers to keep track of any changes or any impacts that might happen to their portfolios. So being a portfolio manager, every time that there's something that I need to be aware about, Sphere is going to alert me on that, either on the platform or via email. Going now through what I can see on my portfolio and the analytics I have, I will stop first to show you that it's not all data, meaning that we have done a recent integration with the ChatGPT, where we have automatic commentaries that basically connect all the dots of the data that can be seen on each of the portfolio. So data is available, it can be extracted, as you can see on the different widgets, but there is also a very thorough summary that shows us where we stand, what are the risks that might impact our portfolio, and that give us a better overview or a summarized overview on what we can see. Then, of course, we have all the analytics, metrics. We have very powerful look-through system on Sphere, where basically portfolio managers can assess exactly the exposures that exist inside the portfolio. And all this information is then taken into consideration during the optimization. So Sphere is totally aware of what exactly our portfolio is composed of. Then we have portfolio factor exposure analysis to see what are the risks that might have an impact on our portfolio. We go to the composition of the portfolio, and then attribution in terms of performance, volatility and performance contribution, and many other analytics that can be assessed for each and every portfolio, again, at different granularity levels. So there are a lot of insights that a portfolio manager can take every day to monitor the portfolios. Going back to the alert, which we left a bit standing here in the beginning, Sphere is telling me that my market scenario is expired, meaning that I'm constructed, uploaded, rebalanced this portfolio, and I have set a specific framework under which the portfolio should be optimized with a specific horizon, and now that horizon is expired. So Sphere is alerting me to that and giving me a suggestion of enhancing my portfolio. To do so, I need to set again the scenario. This is all interactable, as I was saying before, and this is the first step where we can get and fetch the first part of information from the Portfolio Studio. So we can basically select from the views that we have saved to use one of our views, or if we prefer to do so, we can do it using Sphere's forecast. Clicking Enhance from Scenario, I will take you through the different steps so that you can see exactly how customizable this process is. First of all, we need to choose the portfolio universe. So the second information we previously saw on Portfolio Studio. I'm going to choose my multi-asset ETF selection, and then I will move forward. Second step, constraints by tags. At this step, we start customizing our optimization, meaning that if we have specific preferences on single instruments, we can express them at this stage. For example, lock weights, which can be locked at different levels, not just the current weight, but they can be customized. Or in case I have specific groups of instruments to which I have previously assigned tags, I can set allocation thresholds. So for example, I'm not going to activate them all. I could, but just to keep it brief, if I have a set of preferred funds on my portfolio, for example, And I know that this set of funds need to be between 10% and 25% of my portfolio. I can tell this to Sphere and have it considering these allocation thresholds during the rebalancing. The same thing if I have specific limitations for high yield instruments on my portfolio. I can say they can go maximum up to 8%. I don't want more than that. And the tags you are seeing right now are tags that are 100% customizable. So they have no limits. They can be created to fit every portfolio manager's needs. So they just need to be assigned to the instruments on the universe, and then they can be used at this stage as it fits better the activity. Maximum and minimum weights on single instrument is also something we can customize, and then we can move to the third and final step. At this stage, we reach the third information or the third tab that we were seeing previously on Portfolio Studio, and we have the chance to choose a reference portfolio. As I was saying before, it's an option, so I can also go forward and not use a reference if it's not the case. If I do want to use a reference, I can choose from the drop-down list and choose one of the portfolios I have already created. So for example, I have a tactical asset allocation that needs to guide my optimization, and I know that I need to keep a tracking error of 2.5% versus this tactical asset allocation. So this is, of course, another constraint that adds to the optimization to comply with your limits, and that Sphere will take into consideration when optimizing the portfolio. Risk levels can be customized as well, some other targets, and clicking next, we are done with the optimization process, and Sphere will start calculating a proposal that will consider the initial framework that we have set, which can be the one of Sphere or can be a combination of yours, and all the universe, the constraints, the thresholds, limits, risk profile we have set throughout the process.
Thank you, Joanna, for practically even showing us all of the steps when it comes to building a portfolio and even enhancing it, and even taking into account all the portfolio alerts that are provided by Sphere. It was very helpful. Now we're going to get back to that portfolio enhanced later, but I would like to ask upcoming now Lorenzo, since we saw all of these functionalities and maybe our viewers are asking themselves, what are this output based on? So what is this technology relying on to give you in order this enhanced portfolio? Could you maybe shed some light on that?
I would love to. So basically, a lot of the numbers that our AI crunches comes from, again, the Outlook section, the Outlook focus section, combined with, the setup and the references, the constraints that the client can set up. So here I'm showing a quick sneak peek of the Outlook focus section. So at the moment, you can basically select go down to the micro asset classes you wanted to analyze, but basically here you can see equity, you can see different geographies that we model and show, and even the sectorial level of details wherever it makes sense. So by here, you can see basically a really high level summary, which tells you basically not investment advice, but actually, yes, the strong underweight indicator, what is the driver behind this positioning decision, and even what is the currently detected regime for this asset class. Together with these really super high level tags or indicators, you can see basically some historical metrics to give you a little bit of context, assessing the nature of the asset class you are considering, and some expected metrics that our model produces, so expected returns, volatility, and even an estimation of the value at risk of this specific sector in this case. And but we don't just, as Joanna was mentioning, focus on numbers. So we wanted to make this section really actionable and easy to digest. So there is, again, a really nice commentary which basically details you what the system sees for this micro asset class, and additional section and widgets, again, with the factor exposure, this micro asset class is expected to be sensitive to, and some comparison between different peers, and so on and so forth. And just before giving going back to the enhancement part, I want to show you very quickly also the market regime analysis tool, which is, again, one of the two hearts basically fueling our methodology. So here you can see that basically for the Europe geography, you can see what is the currently detected regime, what is the previous one, how long we have been experiencing this risk outlook in this geography, some kind of description, blueprint of what is a regime on the long term, and most importantly, you can see the model in action. Basically, you can see together with some time series plotted against the regimes, you can see basically what is and what was the regime detected at any given date. And I hope you can also appreciate the fact that here we have both, let's say, discrete representation. So here you see the background is basically just colored by one color at any given date. But actually, what the model does behind the hood is actually a richer, a more probabilistic framework, where you can see basically all these transition probability, because actually risk regime is not really something you can know by asking somebody. So there is no ground truth at any given point in time. You could actually only be 100% sure about a regime in retrospective. So just only after observing a long enough period of time. So these models are actually intrinsically probabilistic, and here you can see also, the degree at which a regime is being detected and projected in the future. And to sum up, this information, this is also the part that interacts with the market views that the client could adjust when maybe doing a rebalance of a portfolio.
Thank you, Lorenzo. That was so useful. Now, I remind all of our viewers that if you have any questions regarding Sphere or in general regarding AI investing, you can leave it down in the comments and we will answer them at the end. Or if you prefer, you can contact us directly in the description of this event, and we will more than likely, well, of course, we will answer you. So getting back to Joanna, actually, since she enhanced a portfolio live for you, we would like to get back to that portfolio and see here with you, all of you today, the enhanced portfolio. So Joanna, could you show our viewers the final output that Sphere has given us?
Yes, sure. So going back to the portfolio we were seeing before, our proposal is ready, and now we have the opportunity to open our proposal. Going to the new proposed portfolio that Sphere is suggesting us after the rebalancing, we will have some information on metrics. We will have, again, information on the exposure, this time showing a bit differently, because the aim is to see how the new portfolio is changing compared to the current one. Again, we have all the levels of granularity, and of course, it doesn't stop at the micro, geography, macro level. It goes to the factor exposure, to the composition as well, where you have movements at the single instrument level. So it's just not a change in exposure at the micro and macro level, but Sphere actually gives you buys and sells that you can then download here on this widget. You have the possibility to download the history or download exactly the trades that are suggested. as I was saying, wrongly saying before, we also have the factor exposure analysis, this time comparing the portfolio current with the proposal provided by Sphere, and also with the benchmark that is always also represented here. Finally, last but not least, we have again our proposal commentary, which now focus on the changes and links all the dots between what is changing from the current portfolio to the proposed portfolio. It gives us a very concrete summary on the main changes, how the exposure to the different risk factors is changing with Sphere's optimized portfolio, and some of the parameters that we have set during the optimization. Last thing I would like to mention is that before accepting or rejecting, users and portfolio managers in this case still have the possibility to edit this proposal. So it's not a definitive proposal. We can still review it. We can go through some movements that maybe we would like to edit or not fully accept. And then we can accept the proposal and have Sphere working on the newly optimized portfolio.
Thank you, Joanna. Now, I think that for now, we have covered a very good basis of AI in investing, especially for multi-asset portfolio managers, all the way from theory as to the technology and even the practice at the end as to how we can, well, you showed us, build and enhance portfolios. So at the end, I believe our viewers are wondering, how can I integrate this technology into my investment process? So Axel, now I'd like to call on you so you can show all of our viewers today the steps to integrate AI into the investment process.
Yeah, that's, I think, a very important part. So, after you've gone through that process of, as a user, what you like to do, how to do that, the adaptation is very critical. And so we found that, 3 pillars are very critical to do that. The first pillar is basically called it customize and integrate. So the key thing with AI, and if you remember what I said at the beginning, it adapts. So it's critical that you have an AI, you use an AI that's adapting to your needs and not the other way around. It is one of the greatest features of this technology that it can completely customize the need to what you want to do. So that's the first thing. It has to adapt to you and not the other way around. So leverage internal, external capabilities is the other one. It is, if you think about Andrea's introduction about the number of people we have, about the time we have been doing this, it is clearly not a job for 2 people and a laptop. So it's very complex. If you want a proper academic foundation with it, it's a big task. But having the right partner will really help you in doing this very quickly if you combine that with the internal resources you had. And the third one, and this is maybe one of the most critical one, we call it finding the right mentality. So but having a champion in your organization that really helps you driving that forward, and to make clear that what it does, it empowers humans. It's not replacing them. It's a tool. It has to be used properly, but the tool in itself is useless. So these 3 pillars are very important. If that's given, then it's going to be successful. So if you break this down one more level about the usual turn we have. So number 1, exploration, partner selection, the process, the investment process support, and how the models are trained, and the final integration. So the exploration phase, this is where you really think about what is it, what I need, what is in my investment process that could be enhanced, that could be empowered more, where I could make a real difference. And if you have found that, if you're clear about what you need, then it's about which partner can actually help me with that. So in the partner selection, this is then where you find the provider that makes sure that you don't have to adapt, that the AI is adapting. It's very important. So somebody who is understanding what you do, has the right insight, and can deliver proper suggestions for you. So after this part is done, then together as a team, you would go through the investment process, really understand it, decompose it, and then find the areas where the AI can help. And this, if you remember when I talked about how modular that is, this is very critical. So, we have shown you a very complete way of using AI throughout the investment process, but you might just need one or two things out of that. And the way we are structured, that's able to do. So if this is then defined, where it can help, where are the right steps to take, then it's going back to the training of the model to make sure it exactly meets your expectations, and it completely fits with your investment process. After that's done, then it's basically integration, where it's much more personalized. It's very clear that you define your inputs. It could also be then connected via APIs to your own systems, so that you really have this way of having an extremely powerful tool where you combine your own views, your own ideas with the AI's output. So at that part, after you selected a partner, in our experience, depending on the complexity of what you need, we talk about 3 to 6 weeks until this is completed. So to get started is basically find a visionary innovator within your company who really is believing in the AI, is driving it through and helping, putting everybody within the company on the same picture. Then you can move on. And the teams that are actually needed it's mainly an investment team, operations team. It's only required if you have an API integration. So it's very, very lean in doing that. You don't have to change your IT systems, etc. So it's a very, very slick way of getting this AI to work for you. I think this kind of summarizes the way it does. And we have seen if it's working like this, then it's going a very, very successful endeavor.
Thank you, Axel. It's very useful to know the principles and the practical steps in order to integrate AI in the investment process, especially due to all the investment professionals that we have present with us here today. Now, I believe this is a good point to start our Q&A session, and we've actually already received a couple of questions from all of our viewers. So the first one actually is for Lorenzo. So Lorenzo, how can AI help forecasting market trends and uncertainties for multi-asset portfolio managers?
Well, basically, it's really a big part of what Sphere does, and our methodology basically has been tuned and built in order to be also interactive. So basically, as we were trying to show you before, mainly the regime detection tool comes into action when basically there is a big shift in the risk framework, which is relevant for the universe of the multi-asset manager at hand, let's say. So on one hand, if let's say that asset manager, that asset manager does not have a specific view on the risk and how they could translate into reality, they can basically rely on our own risk detection system. So basically what it does is studying different risk measures at different horizons and with different, let's say, angles. It could be, tail risk, volatility, co-integration, mean reversion, implied volatility, spreads. So by merging this kind of information within a coherent projection, it can address robust portfolios. So basically, it can understand what is the prevailing regime at the moment at different levels, and within a kind of coherence layer, basically help you position in the right way given the current risk outlook. So for example, the question actually contained a keyword, for example, like uncertainty. So basically, our system is able to behave differently if the current regime is considered kind of more high stress, which is really well-defined behavior. And so it is where there are large drawdowns, crazy correlation going on, really even rebounds, so super nervous times. Whereas uncertainty actually has a different characterization. So it means basically it could be a transition happening at different speeds, at different granularity. So the system actually behaves different in this kind of regime framework. So, long story short, the system actually actively manages this part, is one of the core blocks, but it can also accept the multi-asset manager views, or even I would say heuristics on how risk would evolve. So it's a combination of power of the model and the ability to be flexible and accepting human provided inputs.
Thank you, Lorenzo. Now, the next question that we have just received is for Joanna. So, Joanna, can I input my market views, or do I need to use only the AI ones?
Okay, so if maybe it's easier if I show it directly on Sphere, because actually we have both choices. We can do it at the level of the portfolio, so we can define it for every portfolio. Or I'm going to take the example where maybe there is a market view that then needs to be applied across several portfolios. In that case, we can create a custom market view where the view of Sphere is the starting point, let's say, but then we can change it according to our own forecasts, both at the more macro level, so taking into account the probability forecasted for each of the regimes, and going to the level of expected returns and expected volatilities across all the asset classes, because these are all the elements that compose the view of Sphere. So basically, if a user wants to use its own views when rebalancing the portfolio, first step, we choose an horizon. So let's choose 3 months. Then the user can adjust the regime probabilities according to its own estimates. And then the edited probabilities that we see here in blue and that are different from the ones of Sphere will be the ones to be used during the optimization. So to set the stage for the optimization, let's say. And then the same thing can be done at the expected returns and expected volatility levels. So all these little togglers can be adjusted across all these asset classes that I showed before in order to reflect the user's views and not only Sphere's views.
Thank you, Joanna. Definitely very useful
Welcome.
knowing that you can integrate your own views and, well, combine them with the AI's views. I believe it really adds value to anyone that uses this specific platform in their investment process. Now, this next question is for Axel. So, Axel, can you explain the role of AI in optimizing asset allocation decisions across different asset classes and investment strategies?
Well, it can have various roles. I think think about what I said before, that there's this modular way of doing it. So within an asset allocation process, the AI can run that process in a way that leads to more cohesive results than using a Black-Litterman model. But again, clients can choose what parts of that construction they would leave to AI and what they want to have input themselves. So it's like even on different levels, the AI could come in, it would use the same methodology, it would use the same concept that Lorenzo explained. And within that framework, it then would provide the results. So we can do the entire asset allocation, but it can also do parts of it if necessary.
Okay, thank you. Now, the next question is for Lorenzo. So, Lorenzo, how can AI help managers in effective portfolio risk management, especially on downside risk protection to avoid big losses?
Well, this is, of course, a really clear question in general. So, first of all, I want to make sure a really cool concept is clear. I mean, AI system cannot predict black swan events by definition. So, on one side, what our model and robust modeling does is reacting as quickly as possible. So on one side, this is the concept I was trying to stress out before, is that it's really capable of understanding when a risk regime is actually escalating, so getting really worse and worse, and not in a really not meaningful way. So on one dimension, the answer is to be able to detect it as soon as possible in order to act and rebalance the portfolio in a data-driven way, but being sure that actually the risk is there. And that's, let's say, the reactive part. In general, again, the regime detection tool comes into play is that there is never a point in time when the high risk probability is actually zero. So and that's one of the reasons why we built this module at the beginning, because we needed it in order to build portfolio that were kind of resilient also to tail risk events. Always, not only when the risk has been detected, because again, then it's probably either too late or too expensive to act. So what the model does is always, taking care of the fact that the probability of a high stress scenario is not zero, and so injecting in the portfolio the instruments within your universe, within your perimeter, which give you the best protection and positioning for those scenarios. So it's basically not something you want to do just because you are scared. It's the system that knows the level of risk, if it's increasing, if it's decreasing, and even when it's low, portfolios actually reflect the fact there is a not zero chance of quickly improving, degrading the risk framework. So it's both reactive and, evergreen in some sense. It always contains a level of protection, given the fact that there is no really 0% transition probability of a high risk scenario.
Thank you, Lorenzo. Now, the next question, it's actually a person asking, can we test Sphere? Of course, you can test Sphere. You're more than welcome to. You can find the link to get in touch with us in this event description, or you can stick to the end of the live, where we're going to share some contact information, including emails, links, even a phone number. Or if you're eager to test it, you can even go on m.m.ai and you can book a demo right there. Now, the next question we're going to have is for Joanna. So, Joanna, how does the system deal with a portfolio of active managers as opposed to ETFs, which are likely to experience more turnover and requires more of an understanding of that manager's investment process?
So, Sphere, so the management of a portfolio with Sphere, it's basically down to the user to choose when to act. So basically, Sphere will allow you to monitor the portfolio, can rebalance it even every day. Of course, the forecast horizons that we can set for rebalancing are the ones we saw: 1 month, 3 months, 6 months. And Sphere will keep monitoring the portfolio, keeping you aware of any changes, any impacts that might be happening. And something we didn't see is when we set all these alert and notifications, there is also the possibility to set specific and customized early warnings, so that these managers that maybe are a bit more active and need to be a bit more active on their day-to-day activity can actually monitor the portfolio according to their needs. So there is a lot of monitoring and a lot of alerting from Sphere. And of course, then if there's an action that needs to be taken, the enhancement proposal can be created at any time when there's the need to intervene.
Thank you, Joanna. Now we have other questions coming in, so stick, our viewers, in case you wanna also see your question. The next one is for Lorenzo. So Lorenzo, is Sphere applying several forecasting models like ARIMA, LSTM, NN, or is one in particular that uses grid search for optimal parameters?
I wish it was that way, in the sense that, it's not, a grid search on models and their parameters. So it's an ensemble modeling, let's say, controlled by a neural network in general. So it's not really independent models working on their own with, parsing their own data and having, really an approach to machine learning, which is not really ideal for financial time series, because that kind of approach works well, for example, in computer vision or other tasks where you basically can provide with the model a ground truth. So since you have something which represents what actually is the truth, then you can really tune your parameters and your loss functions in a way that basically you're able to obtain and maximize that objective function. But in finance, if you think about it, it's really hard to evaluate a decision or a predicted return, for example, because it can vary a lot in terms of when I evaluate it, like after a day, after a week, after a month, after a year. So like what a ground truth is changes all the time, which is again something really, really hard to manage when doing this kind of modeling. So the point is that mainly the non-chronological module is not separate models that are just combined. So that's the full answer. It has to, we organize it in such a way there is an internal pipeline we can monitor, which can offer, again, explainability, offer scores on indicators, which are actually flow towards Sphere itself. Those are the ones that we just showed before. But of course, there is no way of having different agents, different models, switching between them by, I don't know, some rolling metric. So the tricky part is really the problem itself. Financial time series are really noisy, hard to evaluate. So that approach, not that we didn't try. We have, a long history of researching every possible approach. Here we are just, telling you what it works and what is stable in production. So again, I wish it was that way somehow, because it could actually stay on a more traditional and mainstream, even academic route. But it's definitely too complex to be approached that way.
Thank you, Lorenzo. We have other questions. This upcoming one is for Joanna. So Joanna, does Sphere handle a portfolio of both ETFs and direct securities, both fixed income and equities?
Yes, Sphere can manage a portfolio that contains different types of instruments, so ETFs, also funds, and direct securities. If we have a portfolio that mixes all of these instruments, Sphere is able to manage it as well.
Perfect. Thank you. Now, the next question is for Axel. So, Axel, how does AI facilitate the identification of hidden investment opportunities and potential outliers within the multi-asset portfolios?
Well, part of that is of course, is addressed also with the data that's used initially. So there we have to make sure that, we have consistent data, we have conclusive data, we have indisputable data. So this is one part. So, the biggest problem with all of that, of course, is avoiding bias. And, it starts with using data that's unbiased. And if that's given, then these risks that were mentioned in the question are really mitigated through that. And, on top of that, part within the firm, we have a team that's called Mission Control that would actually oversee the results of the outcome. So they don't question the outcome, and they oversee the logic of the outcome, and they would be able then to point out if something is out of the ordinary. So it starts at the beginning with the input, but of course we have another control mechanism that's on a daily basis looking at the outputs.
Yes, and actually a question related to that about controlling the inputs that then are related to the outputs. Here we just received a question that says, what measures are in place to ensure transparency and explainability? I believe we can direct this question to Lorenzo, as well, he knows most certainly about everything about our principles regarding explainability and transparency regarding our technology.
Definitely. I was briefly touching upon these points in the answer before, but basically transparency and explainability are achieved by two, I would say, pillars. On one side, we have data. Our models really rely on data which makes sense financially. So price action data, of course, everything that comes to the market is part of our system. Fundamental data, so basically at different aggregation levels. So fundamental information about firms, fixed income curves, and so on and so forth. And then macroeconomic data, which again has a different frequency of this kind of information, but provides meaningful context to what the model does and how different risk regimes can actually interact with different macroeconomic conditions. So first of all, we really need to understand what is the data, what it represents, and how it flows through the system, which is the second block. So what we did was not having a black box. That was our main goal at the beginning for two reasons. Since, first of all, because we wanted a way to understand if the decisions were good. So we needed a way of, as researchers, to know why every bit of information implied a different decision, for example. So we basically retraced what I would say an investment committee does. So we broke down every step of the modeling in such a way we would be able to see through it and inspect it and understand if it was relevant towards with respect to the final, let's say, outcome. On the other side, by knowing what data represents, we know for sure that there won't be a disruptive effect, let's say, between these two components. So the full answer is that we made it by design somehow. So we basically broke down our modeling logic into a pipeline. And so by knowing exactly how each block of the pipeline works, we know it's working the right way.
Thank you, Lorenzo. Now, this upcoming question is for Joanna, once again. So, Joanna, can you provide examples of successful use cases where AI-driven investment solutions have improved the performance of multi-asset portfolios?
Sure. We have several examples because, in fact, as we were seeing before, it's a very fast, very easy to use tool. So there are a lot of processes that with Sphere become much easier. For example, the fact of being able to construct a robust scenario that gives you a robust forecast of what is expected in the upcoming month is something that then you can combine with your inputs as well, with your universe, and get a fastest output that maybe previously you were getting in a much longer period. You were maybe having a lot of people working on the construction of a framework that was not that accurate, or maybe you just needed a help of the AI to combine and to give you some other inputs that were missing or that were hard to get without it. So I think the best successful example of integrating to the different users we have, the different use cases we have built so far, is mainly that part that the process becomes more efficient, is more flexible, and it really adapts to all the needs that the users have, and then gives a lot of space to focus maybe on other priorities and to enhance other processes that were not being considered so far.
Thank you, Joanna. Now, as a follow-up, we do have another question for you. So, in terms of asset classes, instruments, Can Sphere handle currency forwards, so for hedging, and other derivatives too? And where funds are held, does it just consider them based on currency or fund geography, effectively as an equity, or can you look at underlying constituents?
Okay, so first question on derivatives, the answer is no. For now, Sphere is not managing derivative products. For the question regarding the funds, yes, I showed previously before the look-through system that exists on Sphere is exactly to go and look through the fund and be exactly aware of what are the exposures that are inside that fund, so that Sphere can be aware when monitoring, optimizing, giving all the analytics. Sphere is totally aware of the underlyings of each of the funds that are present on the portfolio.
Okay, thank you, Joanna. Now
You're
we have
welcome.
another question for Lorenzo. So, Lorenzo, what types of data and information sources does AI utilize to generate investment insights, and how are they integrated into the decision-making process?
So I like the fact that these questions are somehow related, so that's good. As I was saying before, basically we could have actually a huge amount of data. As Axel was presenting at the beginning, actually there is an overabundance of information which actually we need to cut through. So that's how the set is staged somehow. And let's think about it in terms of on one dimension, I would say the predictive power a potential data point has, and its relevance of horizon of relevance, I would call it. So in this plane, basically you could have really small term, low predictive power data points, which are usually sentiment or this kind of data that basically only makes sense if you work either on a daily basis or really short-term trading framework. On intermediate level, you could have alternative data whose, let's say, time of relevance is kind of intermediate. And again, its predictive power is, let's say, it really depends, because you could potentially find a really powerful edge on alternative data, but it's gonna decay really, really fast as soon as the market absorbs the same kind of information. So it's kind of in between the two sides of the spectrum. At the end of the story, actually, the most powerful data points are the one coming from market action. So price distribution, correlation measurements, risk tail measurements, implied volatility measurements. So everything that basically comes from the market, which again discounts a lot of information. We have fundamental data, so like fundamental analytics for firms, companies, aggregated at sectorial, industrial level. The same for more of the fixed income and commodity part, and microeconomic data as well. So like GDP, interest rates, different geographies, and inflation data, which we know it is really, really important, especially in the last couple of years. So the model really focuses on the latter cluster of data points. We have a lot of ideas on how to make sense of the first ones, but they are still on more on the pure research side. They are not again on the applied research, really robust modeling that we have in production. So to give a short answer, we really rely on structured, deep data, because these models are really data hungry. They want long historical records in order also to know how to make the system robust with respect to dirty data points that could enter the system. So the more history we have, the happier the model are, and the more transparent and explainable the system is. So that's why we rely on really top corner data points, which have a lot of structure and information.
Thank you, Lorenzo. Now, we received another question that says, how can I trace fear? Well, again, you're more than welcome to see the description to this event. There's a link where you can contact us, or you can stick to the end where we're going to be leaving emails, phones, QR codes, everything in order for you to see our research materials or get in contact with us. And if you're eager to get in contact with us, you can search m.n.ai and you can book a demo from Sphere. It is completely risk-free. We will get in contact with you so you can try Sphere yourself. So I believe this is a good time for closing, since unfortunately we have received so many questions, but we have, overlapped our time. So in closing, this event has really, I believe, provided us with invaluable insights into the topic of AI and investing. It is really evident that AI has established itself as sort of this enduring presence, and well, it presents immense value for portfolio managers today. And by embracing AI, institutional investors can really foster innovation and secure that distinct competitive advantage in today's financial landscape. We trust that the real-life examples that we presented today will serve you as valuable insight so you can embark on your own AI adoption journey. Thank you all, and goodbye.
Thank you.